of ESG reporting in sustainable economic development in India. My name is Inga. I am the strategy consultant at ESG Risk AI. I will be here today with you throughout the webinar to introduce ESG Risk AI and our eminent speakers, as well as to ensure your questions are being addressed. But first of all, let me all thank you for taking the time out from your busy schedules and attend today's webinar. I'm very excited you are here to make this a vivid session. Let's start by giving a brief background on ESG Risk AI and assessments and insight. In short, ESG Risk AI. We are a wholly owned subsidiary of Equity Ratings and Research Limited, with more than 15 years of rating and grading experience. We are proud to be India's first ESG rating company with an India-specific ESG rating framework. Our comprehensive assessment methodology and tools allow us to assess and rate companies' ESG risk management performance while we follow global standards. We have ensured the integration of relevant environmental, social, and governance compliances, development challenges, as well as targets that are specific to India. Besides pioneering ESG assessments in the country, we make it our mandate to shape and drive the discourse on ESG and its relevance for India's development targets, which is in fact the purpose of today's webinar. And I'm glad you are here today to be part of this. Before I start, some organizational points. If you have any questions during the panel discussions, please share them in the chat box so that we can compile them and address them towards the end of the webinar. We will also try to answer as many questions as possible during the question and answer session. Also, please make sure you are muted so that you do not disturb any of the ongoing sessions. Coming to the topic of today's discussion. As we all know, environment, social, and governance risks and their management have gained tremendous importance worldwide. Climate change, cyber attacks, pandemics, to mention a few, affect our lives, business, and the economy at large. In India, ESG as a subject is still nascent. However, Indian regulators and international investors have made it their task to take concrete steps towards India onto the global ESG map. To elaborate on why regulators, investors, banks, and customers pay so much attention to ESG performance of companies, I will now hand over to Shankar Chakraborty, our Group CEO of Equity Ratings and Research and Chairman of ESG Risk AI. Shankar has led Equity Group's transformation from being the world's first SME-focused credit rating agency to a technology and innovative-driven knowledge and opinion provider. He has some more than 2 decades of expertise in developing and offering data analytics, risk management, and financial research solutions. Shankar, welcome and over to you.
Thanks, Inga. And I would like to welcome all of you to today's event. This is the first of the series of events that we are going to bring to India. I would like to welcome all my fellow panelists, Gareth, Ramnath, and Ms. Aditi. Let me start out with a little background of Equity Group, and then I'll set the background for our panelists to take over. Equity Ratings and Research is one of India's 7 accredited credit rating agencies, and it received its registration from SEBI in 2011 and accreditation from Reserve Bank of India for bank loan ratings in 2012. We started our operations in 2013, and since then we have rated about 8,500, little more than 8,500 companies in the bond rating scale, which is AAA to D scale. Our strengths, as we have identified, is innovation, bringing new products and solutions to the ratings universe, and use of technology in carrying out credit ratings internally at our end. We are established under the aegis of Ministry of Finance, and we started our journey in the year 2005 as world's first SME rating agency. We are 100% promoted by institutions, which includes Dun& Bradstreet and practically all the large Indian banks and Citi. At the time of its establishment, Smera was the first SME rating agency in the world. And today we have rated almost 50,000, little more than 50,000 SMEs across the country, across various clusters, SME clusters in India. We evolved into Equity Group in 2008 as part of a rebranding exercise to better communicate to the market our capabilities and strengths. We are a full service credit rating agency offering entire gamut of rating capabilities, including bank loan ratings, bonds, money market instruments, and SME gradings. We also offer industry and economic research. With the launch of ESG Risk AI, we are the only credit rating agency in India that covers the three pillars: credit rating, SME, and ESG risk assessment. Our services are backed by 15 years of rating modeling, assessment, and research experience, in-depth knowledge of Indian market, and a pool of very high quality analysts. Now, let me turn to why regulators, investors, banks, and customers uh, are now paying attention to companies' ESG performance. The world of today is very different to that of the late 20th century. Environment, social, and governance issues, in short, ESG risks demand immediate attention. Government and companies no longer only deal with economic risks, but also risks emanating from globalization, environmental degradation, social changes, and advent of new technology. To deal with this changed global risk landscape, regulators have taken clear actions to address and manage the ever evident ESG risks. Examples are the EU Sustainable Finance Action Plan and the introduction of ESG disclosure bill in US Congress. Increasing numbers of mandatory and voluntary regulations are aiming to promote responsible business practices, improved ESG risk management in corporates, and sustainable and inclusive development. By and large, have been targeting improvement in the process in the risk management setup of the corporates. Investors, banks, and customers back this drive and demand companies to provide evidence of their contribution and ESG performance. To do so, corporations closely scrutinize their operations and supply chains and weed out non-compliances and implement strategies and programs that mitigate ESG risks. As such, companies move beyond the conventional business and financial performance focus and include ESG risk assessments that introduce the sustainability factor not only at the company level, but their impact on the economy and society by and large. It becomes evident that companies and countries need to act fast to avoid costs and damages brought up on them through environmental, social, and governance risks, if not addressed and managed in time. ESG Risk AI is a logical extension of Equity Group's services. Our discussion to enter the ESG space started in the year 2018 when we observed significant shareholders' wealth destruction at large, highly rated companies because of governance related issues. Economic and social losses due to an increase in natural disasters also made a strong case for environmental sustainability and assessment of effective mitigation standards. ESG risk assessment and insights was therefore a natural extension of our grading and credit rating services. Understanding that the Indian economy has its own peculiar challenges and aspirations, our assessment tools are tailor made to capture the Indian context. Our tools help companies benchmark their performances both domestically and globally, providing an independent perspective on how they fare on the environment, social, and governance front. We assist companies and investors at all levels to understand and improve their ESG performance against their industry peers. Where are we in India? Let me say a few words on the ESG adoption process in India and who is driving it. The level of integrating ESG risk management differs from country to country. On the global ESG map, India's ESG activities are still very, very nascent. Nevertheless, we have seen rapid deployment of ESG in India with marked interest from all quarters of the ecosystem, ranging from banks, asset managers to regulators. With investors increasingly using a company's ESG performance to guide their investment decisions, let us look at ESG themed investments as an indicator. Today, ESG themed investments are estimated to account for 40 trillion US dollars worldwide. Out of these, India's share is a mere 7%, equivalent to 2.1 lakh crore AUM. This is negligible when compared to EU's, Canada's, and Australia's share, which is hovering around 50%. However, Indian regulators have made it their mandate to promote sustainable and inclusive growth and responsible business practices. The Business Responsibility Report, the National Voluntary Guidelines, and are now mandatory CSR rules are some of the examples. There are more than 92 regulations focusing on the environment, some 127 plus focusing on social aspects, and some 128 plus ensuring good governance. As such, the management of ESG risks in Indian corporates is becoming a matter of compliance and key to stay competitive. With these developments in place, India's ESG themed investments are estimated to increase to 30% by 2030 over rupees 20 lakh crore. Let me end here and rather take the opportunity to introduce our first webinar, which is part of a series designed to start a meaningful conversation around this very important topic. As part of today's first webinar, let us explore how integration of good ESG practices into core business strategies opens doors to untapped investment opportunities, immense cost savings, and business expansion opportunities. Thank you so much. I look forward to a very healthy discussion today. And over to you, Inga. Thank you. Inga, you'll have to unmute yourself.
Thank you, Shankar, for your wonderful insights and setting the background for today's panel discussion. With that, let me introduce our panelists that are already eagerly waiting on the screens to be introduced. Our first panelist is Dr. Aditi Halda. She is an expert on sustainable development with over 24 years of experience in integration of sustainable development and transparency into policies, performance, and communications through measurable enablers and results. She is the director of the South Asia Regional Hub of the Global Reporting Initiative, GRI. Her primary role is to advocate, research, communicate, and to dialogue with multi-stakeholder consistencies in making sustainability and transparency a standard practice amongst the South Asia region and the global community. Thank you, Aditi, for being here today. Our second panelist is Mr. Gareth Phillip. He's a manager, climate and environment, environment finance of the African Development Bank. Mr. Phillip has a vast experience of over 25 years in climate and environmental finance and is specialized in climate adaptation and mitigation, forestry, and land use. A warm welcome to you too. And last but not least, our third panelist is Mr. Ramnath Iyer, co-founder of ESG Data and Solutions. Mr. Iyer has also rich experience of over 25 years in leading operations and technology across various business areas, including ESG ratings, credit ratings, estate, and equity benchmarking, corporate research, and advisory. Hi, Ramnath. I'm very happy for you to join today. So, without any further delay, let us start the panel discussion. I would start with questions for Aditi Halda, Director of GI. Um, nice of you to join. The first question kind of wants to give us a background to what you are doing and relates to how do GRI standards help investors with their investment decisions. Maybe you can elaborate a little on this.
Okay. Yeah, thank you, Inga, for the invitation and organizing this interactive session with the great panelists that we have here to enrich our discussion today. So a little bit of background first on GRI. So GRI is a Global Reporting Initiative, and it is an independent international organization that helps businesses and other organizations to take responsibility for their impacts by providing with the global common language to communicate their impacts. We as an international organization, we also work with the regional and national policymakers, regulators, investors, civil societies, labor organizations, and educational institutions, and of course businesses, to mainstream sustainability reporting through the uptake of the GRI standards. As you know, GRI was kind of formed almost 24 years back. And that time, I think it was just an initiative which was supported by the United Nations Environment Programme. Later, it became an independent entity to be housed in the Netherlands. So we have a network of 7 regional hubs, ensuring that we can support organizations and stakeholders worldwide by reaching out to them on the ground. So the integral part of GRI is to really engage with businesses, help businesses look at their impacts, both negative and positive footprints, and help them take a step forward to disclose information about both their negative and positive footprints. So the negative footprints should bring out an opportunity for improvement on where they want to go, what is the strategy for the business for their development, and within that development and growth path, how does environmental and social and governance issues really bind into their business strategy to look at their opportunities and risks at the same time. But on the other hand, we work with government and regulators to see how this mainstreaming can happen, not only through proactive and voluntary decisions by businesses to use a disclosure mechanism for their improvements and for their target setting and for their strategy development, but also to give a little bit of push by regulators to make it mainstream at a faster rate. So in this web between the regulators, which is the regulation, that is the stick, and the proactiveness and the voluntary mechanism by businesses to see the carrots of how business can grow in a better and a much more steady manner, the capital markets engagement is a crucial one. So with capital markets, GRI actually engages with investors, regulators, and stock exchanges. They are the key audiences of sustainability reporting because they play a vital role in using reported information to offer responsible investment and create transparent and sustainable capital markets. So what we essentially do is that we engage with these 3 parties, that is investors, stock exchanges, and capital market regulators, in dialogue with the reporting organizations to support the knowledge and use of sustainability reporting and help lay the groundwork for resilient markets and sustainable finance. So it is not just that we empower businesses, but the GRI standards and the disclosure based on the GRI standards should empower developing a resilient market and a sustainable finance for the whole nation. So what happens is that the standards, which is principle based, it is not prescriptive in nature. It gives information about an organization's outward impacts on the economy, environment, and society. This information gives insight into the organization's efforts to contribute to sustainable development. And it provides a window into financial material risks and opportunities facing the organization. So that's where I think the first step that a business organization should look at using the sustainability reporting as an approach is that their ultimate purpose of reporting should be to build in transparency and sustainability as a culture within organization. So what is happening in India is that we not only train and with our training partners, we not only engage with business leaders, but we also work with regulators like SEBI and others in the South Asian region. In Bangladesh and Sri Lanka, we are working heavily with the stock exchanges. And in India, we are also working with the Bombay Stock Exchange to see how sustainability reporting can become mainstream. The good news is that in both Bangladesh and Sri Lanka, especially in Sri Lanka, the number of listed companies that are using GRI standards are quite high. Yeah, and based on the number of the publicly listed companies. But in India, on the other hand, because the number of listed companies are very high, we see that the SEBI has also brought out in 2015 a notification on business responsibility reporting. So the frameworks by SEBI looks to be more easy, more like a checklist, and it is because it is given by the regulator of India, so companies have to abide by it. So at the moment, we see that around 80 companies out of the top 500, they are using the GRI standards, and the remaining 498 companies, they seem to be disclosing information around some or the other topics of the BRR, and reflecting through a signature that they are having a business responsibility report. And that report is not in full-fledged using all the elements of the BRR or the GRI standards, but some information in their annual report with an annual commitment that they are disclosing on environmental and social risks. Now, the point here is, what is the kind of information that goes out, and what is that the regulator do about these informations? So that is where we are at this point of time. I will come back to you with more information when I think Inga will be directing us. Yeah. Thank you.
Quickly summarize your nice introduction to GRI. Thank you so much. So you displayed beautifully how the role of regulators, the companies, and the capital markets all really play together. It's not separate entities, and everybody has a need and a role in the global reporting. And you showed nicely on how at the company level, it should become transparency and sustainability should become a culture. And that this then will help by being incentivized also by the governments, how you just in the last sentences highlighted that there is mandatory rules, helps in creating a resilient market that then again the investors can use to make responsible investments. So thank you very much for that introduction. And I wanted to break you, sorry to interrupt, but I really wanted to highlight what you were saying in the last couple of sentences, which was already going towards where I was heading, which is how many companies have adopted GRI standards in India. You brought some other countries' examples, but let's really look at India and see how many companies do we have and how many are currently using it. And you were elaborating a little on to what extent they use a principle. So maybe you can highlight that one.
Yeah. So, so the top 500 we looked at, and we looked at the top 100 based on the market capitalization. So we see 74 of those top 100 are using the GRI standards for many years, and now also, in the last 1 year, I think there were a raise of more than 5 companies coming into this list. And if you look at the top 500, I think there are lots of companies who are using the business responsibility report, but not the GRI standard.
Thanks so much. I mean, and just maybe for the audience, the difference between the business responsibility report and the GRI standards, can you elaborate a little on that?
So, so the difference, I think it's a 2-day session on really bringing out the difference. I won't go into the technicalities, but I think the major difference here is on materiality. Yeah. And from the beginning, I think GRI standards was created to actually empower businesses to decide what is most relevant for themselves to disclose on. And the relevance criteria is on the business risks and opportunities and what is the impact on the stakeholder. So here we see in the BRR, it is more or less that you kind of give information out. And another very important, difference is that in the GRI standards, because it has evolved through a global stakeholder network-based input coming in, every disclosure point, which we call as indicator or topics, they are actually kind of held by a protocol of disclosure. So how do you measure each of those? So it's gone into a very granular level of information disclosure, whereby GRI wanted to bring more comparability and bring more structure and systematic disclosure into the whole process. Yeah. So that's where I will stop. Otherwise, I think I will take the entire session.
Yes, thanks. But I think this gives a little bit of a background to our audience. And maybe one more question for you. When we look at the benefits of adopting GRI reporting standards, both for the issuer and the investor, how would you term those benefits?
I think the first level of benefit, and which is the most important one, is that I think the GRI standards, create a compact between the issuer and the investor, and how does it happen? It creates the trust by giving the common reference point, because it is a standard. So the common reference point is by the report, preparer and the report user. So the report user can also have this common point of reference, understand the GRI standards, and use it. The other thing is that if a report user wants particular, topics to be disclosed, they would also know why a particular business from a particular sector and scale needs to disclose information around those topics. So that is where I think it brings in a level of trust, whereby it is not about just a demand, but an expectation with a logical approach of why that demand for that particular information to be disclosed is needed by the report reader or the report user. Yeah. So I feel the benefit is not only to the report user, but also to the issuer, that it can set target, it can move through an incremental process to redefine the business strategy, and maybe relook at the vision and the growth path of the business organization in a structured manner.
Yes. So it becomes also a tool for managing the operations at a company level.
Correct.
Yeah.
Yes.
And now Shankar had earlier mentioned that we have an evolving risk landscape, where environmental risks keep on increasing on the top 5 risks that affect companies, also social risks, like we had the pandemic, etc. Are those GRI standards static, or do they evolve with increasing disclosure requirements or changing risk settings?
Yeah, so it's a great question. I think for everyone's benefit, because sometimes when, like a person like me, when I'm within the organization, I take things for granted. So for everyone, I think So GRI is evolving, and we went through a pattern of starting off with the guidelines with the version 1, then we moved to 2, then we moved to 3, 3.1, then G4, and that's it. And then I think all the stakeholders, which is about, I think, like 30,000, network members, they all came together to decide that it's high time GRI moves from being a guidelines where there was more scope of not using versus deciding what to use and what to disclose, to moving to making it a standard. So thereby the standard actually gives in more better approach of compliance, and also the ability to refer to making comparison between the like sectors, So that is the important development. And every time a development happened, it was not that the GRI Secretariat decided. It was the network from different multi-stakeholder groups from different parts of the world came together to decide. The other thing which is very important to understand is that I think around 2012-13, one of the topic which became very important is integrity. So we actually re-looked at the entire dimension of integrity to bring in particular disclosure on this topic. So similar evolutions keep on happening till date.
Thank you. And I think this is key because we are permanently facing new developments, and it is important for standards to develop and for rating systems to develop. So thank you, Aditi, for all your insights on what GRI, the global reporting standards, are and how they relate to compliance. In ESG Risk AI, we have included all your indicators, and we follow also all the BRR, business responsibility report indicators, and show transparencies of companies. So I'm happy that that overlap for sure is there. Let me move to Mr. Ramnath Iyer and elaborate a little and bring a perspective on beyond compliance. Why do we have ESG emerging, and why our companies are really interested in reporting beyond compliance? So Ramnath, my first question to you: why is reporting beyond minimum compliance requirements important and beneficial? Why should companies not simply look at what the government requires them to do and stop there?
Right, Inga. So let's understand why are ESG disclosures, or how are ESG disclosures used? So first, what we need to understand is that ESG risks are financially material to companies. Let's take a number of examples, right? We know the 737 MAX accident, and let's look at the stock price of Boeing before and after the accident. So right on the day of the accident, the stock prices plummeted, and look up the stock prices today, they have not recovered. Let's take another example, Volkswagen Dieselgate scandal. The day the scandal became public, the stock prices tanked. It's almost 3 years from the time the scandal became public, it is not recovered. So what are investors now using the ESG disclosure for? They are using the disclosure to quantify the risk and see if the investment in the companies that they are picking up for as investors going to be secure, or are they exposed to financially material risks? Now, if the companies are only complying with the disclosures, then what are investors going to do? The investors are going to say that to the extent of your compliance with requirements, I can assess your risk. But the areas that you are not disclosing, the risks remain hidden. So what we have to understand is greater transparency automatically means that better ability to assess the risk and greater investor confidence. So simply, the reason to be more transparent is to provide more confidence to your investors, saying that all your cards are on the table. All the risks that I will go through are available clearly and disclosed clearly. And in case you need to invest, here is what I'm doing proactively to manage future ESG risks. Now, there are a number of cases in point closer to home. You might say Boeing is not relevant to us, Volkswagen is not relevant to us. Let's take the case of ICICI. Who in this session would have heard about the clause of malus and clawback? Nobody, right? None of the Indian companies had disclosed that they have a malus and clawback provision. But the moment the CEO of ICICI was moved out by the board, the next thing they did was asked her to pay back the bonus and the stock options granted to her over a period of X number of years. How did they manage to do that? Because they had a provision which could claw back the benefits that the CEO gained. So this is why disclosures are important, and this is the comfort investors get when companies go above and beyond in terms of their ESG compliance and then ESG risk management strategy.
Thanks for giving us these very clear examples. I mean, transparency clearly gives insight to investors for judging how much they can trust a company in being exposed to certain risks and how they manage them beyond what is there as a regulation. So that is clearly something that companies should be looking at. And how many how are ESG ratings being used by investors? So they have random access. They ask the companies. How does it work?
So typically the disclosures don't really convert into a summary that investors can readily use. So if you actually look at a company's disclosure, they would put out 200 plus pages of documentation, and the documentation will address how they are managing or foreseeing risks on different ESG aspects and how they are managing risks on ESG aspects. Now, how do investors across the world, so let's say there are, in terms of relevant market size, nearly 15,000 companies across the world. So how would investors pick up 200 plus page for 15,000 companies and make sense out of it? And what we need to understand is they're not to make sense out of a single company, but they have to look at the industry in general, how companies compare in terms of global practices, and what are the specific country specific risks that companies are exposed to. So this is where assessments or ratings come into play. So what the assessments do is convert these 200 pages into 20 pages of relevant insights, which can then be compared across the 15,000 companies in the globe, and then can be used by investors to benchmark, saying that, okay, if I want to invest in a company that has got great practices in terms of greenhouse gas reduction, then globally, these are the 15 companies that are doing it. The 5 companies I am interested in India rank here compared to where the global practices are. And if I take an exposure to these companies in India, then this is the kind of investment they will end up making in terms of carbon sequestration, management, or trading. So this is the kind of insights that investors are looking for. And this is the kind of insights that ESG assessment stroke ratings provide. So essentially convert the 200, 250 page disclosure into a 20 page summary that investors can consume as a capsule and support their decision making.
Yes, you clearly illustrated it is next to impossible effectively to compare these 15,000 companies otherwise and use their information in any comparable manner, and to also benchmark that information. I mean, I think somebody would sit there for years trying to work out what to do. So if this is available now to investors, this ESG reporting, and they can use it, why would governments make ESG reporting mandatory, and why do some governments choose to maybe don't not have mandatory rules for ESG reporting?
So what we are seeing is that, let's understand carbon emissions, right? Carbon emissions, if you look at just the scope 1 emissions, scope 1 is what are the companies directly responsible for. Then you will see that the largest emitter in the world is power generation companies, and the second largest is the transportation as a sector. But the moment you add scope 2, you will realize that the entire game changes and the largest emitter becomes the industrial sector. The governments are now committed under the Paris Accord to bring down their emissions to sustainable levels and even bring it down to zero by 2050. Now, if the industrial sector does not have practices in place that can help them reduce the emissions, how will the government's accords get, or the treaties get fulfilled? So the only way is for the industry to get their act together and say that, okay, even if the power generation companies are using coal, I will not take anything other than renewable power. I will make my processes more efficient. I will make my packaging more sustainable. And these are the commitments that are needed by the corporate sector for Paris Accord to be successful. So unless the government makes it mandatory, irrespective of whether the investors are looking for it or not, unless the government makes the disclosure mandatory, the philosophy always will be disclose as less as you can and only as much as is needed. So that is where the governments have stepped in and put the regulatory dictates in place saying that, listen, this is the base level of disclosure we expect from you. Anything over and above is driven by the investors who say that unless I get adequate transparency, we will still choose not to invest in these set of companies.
Great. I think this really nicely spans back to the mandate of a country on having a certain development goal and target and having signed treaties like the Paris Accord to achieve that, and how they need to manage within their own ecosystems, the companies, in order to achieve their targets. Beautifully said. Thank you, Ramnath. And now, if the company is having the carrots and the stick, how do ESG ratings help companies and investors?
So let's understand how it helps companies, right? So one of the things that we have to remember is the concept called a fat tail risk. What is a fat tail risk? A fat tail risk is a risk that is sitting in the horizon, looming in the horizon, which the company is completely oblivious about. And suddenly when they encounter it, they scramble to address that risk. And the way they scramble is end up spending parts of money, which were never budgeted, which were never accounted, and then suddenly bring down your profitability. Now, the companies typically can use ESG ratings by staring into the future and saying, okay, this is a bunch of companies or my peers who have already seen the fat tail risks. They are putting policies together. They are earmarking funds to address these risks. They are changing the way they are operating to ensure that the risks are under control. And it is time for me to wake up and I see the risks and put my practices together to address the risks in the future. So this is how companies are using ESG ratings. They're essentially seeing what their peers are doing, seeing why the peers are doing it, understanding if this is happening globally, how much further can India be from adopting similar practices and changing their approach. Investors are using it for both. They are using it for chasing alphas. Now, what has been clear and is established through tons of research is the fact that ESG leaders are providing better returns to investors, irrespective of whether it is a boom cycle or a bust cycle. So investment in ESG leaders, and I mean, Tesla is fabled, and Tesla is an ESG leader because it is making more money through carbon trading than the sale of car. We all know that. But Tesla is not the only case. There are people in healthcare who are making money, people who have foreseen issues like pandemic and have invested in vaccines that are making more money. People who have addressed social problems are making more money. And this is where you actually end up doing good while making profits in the bargain. And companies that are more ESG responsible have been proven to balance the two, which is the environment social responsibility along with the profits. And the investors have now realized that using these kind of ESG assessments to find companies who are able to balance people, planet, and profits are better investment bets than companies who completely ignore the ESG risk and say, okay, let me chase profits for now. And that is how investors are using ESG assessments today.
Thank you. So really, companies get the opportunity to identify what they need to deal with right now, act now, and rather than wait and crumble later. And investors know that there is a financial materiality to good ESG performance. And in the long term, their returns are stable, maybe not the highest, maybe, but also definitely not the lowest, and not exposed to the risks like you had mentioned in my first question, that from one day to the other, they crash down to next to zero. So thank you. I think this gives a good insight how ESG ratings really relates to regulators, why companies should do it, why investors use it, and again, how the three are really mixed in each other. Now let's move to the more practical aspect on development targets. And here I would like to ask Gareth, why does climate adaptation receive less attention than mitigation? And what are you doing about that when we have clear Paris Accord agreements?
Thank you very much indeed, Inga, and thank you for the invitation to join the session today. I found the discussion actually very interesting and very relevant, and I think a number of Ramat's points provide a very good segue into some of the points that I'd like to make. So we heard from Ramat's presentation, he mentioned the issue of mitigation and reducing greenhouse gas emissions. And this is an activity that I would expect everybody in the audience to be relatively familiar with, and the push of the Paris Agreement to reduce greenhouse gas emissions against now all countries having their nationally determined contributions. What I think is very interesting is that we've pretty much overlooked the fact that there is a second part to this whole climate change debate, and that is adaptation and resilience. It's about coping with the impacts of climate change. And actually, I learned a new word today, factile risk. Adaptation is a factile risk. It is something that is sitting on the horizon, and there are good examples of how adaptation has impacted very severely on companies that maybe I can draw out later on, but it's definitely there, and it's something that we're going to have to take a lot more attention of as we move forward. Now, why is mitigation so easy to invest in? Well, it's a subsector of mitigation that's very easy, and it's predominantly renewable energy. And the reason why mitigation in renewable energy is so easy to invest in is because there is an underlying cash flow associated with the sale of electricity. And in the last decade, there was a big emphasis put on additional payments if you could deliver renewable energy, and that was under the Clean Development Mechanism, and India did very well in the Clean Development Mechanism. So you had a lot of project developers selling out electricity and carbon credits or certified emission reductions, which boosted their returns. There are other technologies that are mitigation technologies that don't have underlying cash flows, but the carbon markets made them very attractive. Some of the industrial gases and some of the agricultural gases, methane, and so on. So those were areas where we saw investment because of the carbon markets. But adaptation, most adaptation projects don't have cash flows associated with them. And if they do, they tend to be very long-term and marginal cash flows. So the kinds of technologies that have adaptation technologies that have cash flows, for example, irrigation or potable water supply, retreating water so that it can be used. Well, those are climate resilient agriculture, but these are things they're not up there in the kinds of technologies that have good returns. They face financial barriers, and then there are many other adaptation technologies. For example, planting mangroves to protect coastlines from erosion and sea level rise. Of course, there's no cash flows associated with this, so it's very difficult for the private sector to get involved in adaptation, and the finance that is currently available typically comes from the funds, the Adaptation Fund, the Green Climate Fund, the GEF, and so on, and it comes mostly in the form of grants provided to public sector organizations, and basically the private sector has no particular role to get engaged in that. Now, at the African Development Bank, we're very focused on adaptation because Africa actually has very low greenhouse gas emissions, but we have huge challenges with adaptation. We have over 600 million farmers who are completely reliant on rain-fed agriculture, and they are totally exposed to droughts and so on. And we have very young populations with some of the same problems that India has as well. And we're very focused on the need to address adaptation. So at the African Development Bank, we are piloting a new mechanism called the Adaptation Benefits Mechanism, which is designed, in a nutshell, it's designed to do for adaptation what the Clean Development Mechanism did for mitigation. We want to pay project developers for delivering certified adaptation benefits. Now, they're not quite the same as certified emission reductions, they're not fungible and they're not tradable, but the basic model is that we want to be able to pay project developers to fill that financial gap so that adaptation technologies become attractive. Back to you, Inga.
Thank you so much. And I mean, clearly, adaptation is not the most attractive subject to go in, and it's also not the easiest to go into when it comes to small scale implementers wanting to reach an improvement. So there is a need for finance. There is a need to go beyond loans and grants. Now, how are What is the role of the private sector to play initiating and supporting climate adaptation initiatives where this gap exists and where the funding is not available?
Thank you very much. I think this is a very interesting question, and it really follows on very well from what the previous two speakers have said, because there is this need to become increasingly aware of the fact that adaptation is a major risk facing companies. Now, let me give you a couple of examples so that you can see the sorts of things that I'm talking about. I've got a range. First of all, one that most people on this call may well have benefited from is working from home. So if you are an office-based company in Mumbai and you are experiencing, or potentially you're going to experience difficult conditions for your staff to travel to work, if you have floods or extremely high temperatures, your transport systems are breaking down, and so on. So your business is at risk from climate change, because that is potentially going to stop your workers from getting to work. You're also at risk from a pandemic, obviously, as we've all very recently learned. So an adaptation technique for companies working in that circumstance is to enable their staff to work from home. That means they need to have laptops, they need to have secure systems to log in, they need internet connection, and you need to provide them with the working flexibility to enable that. So that's a very good example of an adaptation that many people on this call will have been through, and companies will have invested in that, and it's something that they hadn't seen coming, and they've had to race into it. And sort of the next step on from that might be then looking at the working environment and the home environment. Again, I know, or I hear in Mumbai, that you have very high temperatures at certain times of the year, and so it's now becoming increasingly important that workers, even factory workers, can work in an air-conditioned environment. But also, you need your workers to be able to have a good quality of life at home. So maybe you need to reach out and ensure that they have the resources to purchase and run an air conditioner so that they can get a cool condition at night to sleep. And when they come to work in the morning, they are refreshed. So, that's something that you might think about doing, with your own workers. But then I think then the biggest area and the biggest potential for ESG engagement in adaptation is about supply chain. This is about reaching out to ensure that your supply chain is also climate resilient. And we had a good example a few years back. Some of you may remember there were very severe floods in Bangkok and Thailand. And I recall that it completely disrupted the entire supply of chips coming out of Southeast Asia and Thailand in particular. And this had a big knock-on effect for all the computer manufacturers and that industry. But the same thing arises for all agricultural produce. Anybody who is sourcing any goods from an agricultural supply chain, wherever your farmers are, they are going to be exposed to the risk of climate change. And it is definitely worthwhile looking at those risks and saying, what can I do to help my suppliers put in place practices that make them resilient to climate change? And being able to report that through an ESG framework will, I think, definitely add value to your company, because you'll be able to show that you're going to be able to produce despite the climate change and the threats that are coming. So I think there's a real opportunity for the private sector to get involved in adaptation, both within their own companies and then reaching out particularly to their supply chains. And then, if they don't fall into either of those categories, or if they've done everything, then of course there's lots of other communities and societies that need help to deal with things that aren't necessarily related to supply chain, but relate to quality of life, relate to the stability of our socioeconomic systems, which ultimately relates to the issue of migration and radicalization. We have a big problem with that in Africa, where collapsing socioeconomic systems are resulting in migration to urban centers and international migration, and a big issue with radicalization of youth to join radical groups. Back to you, Inga.
Yes, so that really illustrates as like kind of three pockets. So you can either way as a company see that we don't have much to do with climate adaptation activities. Our operations don't relate to it, and we can go into, yet we want to do something good, and we can use our corporate social responsible activities in supporting an adaptation project. Another one clearly relates to companies that have value chains that go down to different levels where mitigation becomes a problem and adaptation to it, to climate. and they can either way directly work on this or use your mechanism to support those adaptation activities, and or they can use your mechanism directly to support any other value chain. So really, in the ESG rating, then it would show up as a positive activity on adaptation, and it would improve the company's rating in that area for the overall ESG rating. So there's a clear link to this. Thanks. That means that keeping in mind that ESG assessments are continuously monitoring the overall ESG risk management, including those adaptation activities and performance, then how can the adaptation benefit mechanism attract investment and improve companies' ESG rating? I mean, I kind of just summarized it, but does the ABM promote sustainable practices and foster access to investment?
Yes, thank you very much. So I think the purpose of the adaptation benefits mechanism is to facilitate this investment into adaptation projects, and that falls into two of those buckets that you listed. One is that you can just go out and find an adaptation project that doesn't relate to your business, or indeed you could structure adaptation benefit projects for your own supply chain, and then you could invest into those and attract further investment. So in fact, you would be improving your business by securing your supply chain and leveraging off this process of the adaptation benefit mechanism. So let me explain a little bit about how it works. In the same way, and some people on this call may have been involved in the procurement of certified emission reductions under the CDM. Or have some knowledge of that. But in the same way as we use in a range of different practices, we propose to create an adaptation benefit offtake agreement with an adaptation benefit project. Now that offtake agreement says that I will pay you a negotiated price for the certified adaptation benefits if you can deliver them. And I won't get into too much detail, but because adaptation projects are very context specific, the certified adaptation projects that come from the certified adaptation benefits that come from one project are not the same as those from another, and they don't cost the same amount of money either. So they're not fungible and they're not tradable, but it means you find a project that you like and you then negotiate with the project developer, and there's transparency in that because the project developer has to show their cash flow or their financial model to show what the financial barrier is. You agree a price that overcomes that financial barrier, and you sign an offtake agreement. Now, that offtake agreement allows or enables the project developer to then go and raise equity and debt. So they can bring in their partners, bring in technology and expertise, and they can go to a local bank, a commercial bank, or a development bank, borrow funds to facilitate the implementation of this project. So then the project gets implemented and the certified adaptation benefits are delivered to the off-taker who pays for them. And that's the money that's then used to repay the loan or the interest or that part of it that was creating the financial barrier. So so this is very much the same process as we did for mitigation. You sign the offtake agreement to purchase the adaptation benefits, and then you would declare those in your ESG or corporate social responsibility report and demonstrate to your shareholders and stakeholders what it is that you are actually doing to make either your business, your supply chain, or society at large more resilient to climate change. And then, of course, in terms of sustainability, of course, we want to ensure that we implement and support activities that contribute to the Sustainable Development Goals, that don't generate negative environmental and social impact assessments. They have to be gender affirmative, if not gender aware. We, of course, are looking to see that these activities, the projects themselves, then become sustainable in their own right, or they're completed once the adaptation benefit payments have been made. So I think I've answered that question. Well, just on the fostering access to investment, just to be clear, this adaptation benefits offtake agreement is the instrument that then opens the door to raising more investment from other sources. Thanks.
So clearly a tool which can, on one hand, increase investment on the other hand, improve the ESG ratings and achieve a country's or region's development goals and also companies' development goals. That's great. How do climate bonds and banks be involved?
So I think one of the problems that we have with financing adaptation projects, I mentioned at the start, is the lack of this business model. There are no cash flows associated with it. So, how do you, if you don't have a cash flow, how do you engage with a bank or a bond? Because you can't pay back the original investment, let alone a coupon or a yield on the bond. So the whole purpose of the ABM is to identify this payment that is required to make the project attractive. And in some instances, like the example of the mangrove planting, it's going to be very difficult to attract in any additional finance. So, the off-taker is really going to have to pay the full cost of the planting of the mangroves. The community can bring, contribution in kind. They can maybe, bring the labor, or maybe they'll grow the propagules themselves. But, the donor or the off-taker is going to have to provide the finance, and it's going to be very difficult to leverage that out from any other source. Maybe there's a development bank would also provide a grant to assist that. On the other hand, the climate resilient agriculture or the solar powered drip feed irrigation, these are technologies that do have revenue streams associated with them, but they're not quite strong enough. So, a climate bond could come in there and say, all right, we'll lend you the money up front and you can pay this back over a period of time. And so I think that the ABM has a real opportunity to facilitate the creation of a much more substantial pipeline of adaptation projects that we could then finance using climate bonds and resilience bonds and so on. Because I think at the moment that's the major problem. It's the lack of pipeline that is holding back the the investment into these kinds of assets or capital funding instruments. Thank you.
Thanks, Gareth. Thanks for highlighting the implementation challenges on the ground that very often kind of get forgotten about when we focus on our daily operations in corporates, and how difficult some things, how easy they are, and how other things, how much investment they require, and not everybody is in a position to actually generate that investment, and how the corporate sector can really play a role in reaching beyond what they're doing and creating opportunities where there's a lack of funding. So thanks so much, Gareth, for joining. I think coming towards slowly the end of the panel discussion, I want to use the opportunity to bring you all together and discuss. And I really would like for you to look at and think about, how do you think the private sector, banks, rating agencies, and development sector can collaborate to make ESG assessments a widely used tool to promote sustainable economic development. So the focus here is on making ESG assessments a tool that can be used more effectively by the private sector, by banks, by rating agencies, and by the development sector, because right now we have them all working partially in India independently. Now, how do we bring them together and make it something that really helps the development of the country? I leave it up to you who wants to start, so feel free to raise your hands. Aditi is smiling. And
yeah. So can I go first? Yeah. Yeah. So I would like to actually propose that I think we've seen this 24 years of GRI and disclosure around ESG. I think there is a plateau which has happened to the voluntary way of actually doing the ESG assessment. And now for, I think, mainstreaming and getting everyone on board to really decide for ourselves, what do we want? Do we need a world where we always face these risks and we continue to live? Or do we make the assessments of these risks and we are better off understanding where we are heading to? So in order to achieve that, I think mandatory requirements are very much needed. And I think when a government mandates sustainability reporting, or when a government mandates maybe ESG rating, through a collective mechanism, which is good for everyone, I think that will help contribute to sustainable economic development. Yeah. So that's where I think the carrots and the sticks go hand in hand. We have to build on both.
Yes. Thank you. And yes, it does require certain mandatory steps, and it needs to be a collective. Maybe Gareth and Ramnath, can you add to this?
Yes, thank you very much. I think coming back to the Paris Agreement, I think this is an area that is going to become increasingly significant in the future. As you know, there's a big conference in the UK in Glasgow coming up this year, COP26, where we hope to see significant progress. And with the US re-engaging, and I think we'll see all countries now, or almost all countries, addressing this much more seriously. Now, within the Paris Agreement, there is a requirement that all financial flows in the future are aligned with the objectives of the Paris Agreement. And that means that they need to consider both adaptation and mitigation. And I would think that ESG reporting is a great opportunity for companies to demonstrate that they are becoming Paris-aligned investors or Paris-aligned companies, into which investors can put their money with the knowledge that they will be investing in Paris-aligned activities. And I think you will see pension funds and the big institutional investors, they will be next on the line to say, you have to say when all of your investments are going to be Paris-aligned. They're still struggling with divesting from their coal-fired and oil assets. But the next thing is they're going to have to demonstrate that they're Paris-aligned. And I think ESG reporting is a great way that the private sector could set themselves up to receive those investments. Thanks.
Thanks, Gareth. And maybe Ramnath, you want to pick up on?
I have nothing to add here, Inga. In fact, Aditi and Gareth have covered everything. So maybe we should look at some other questions that are coming through the audience who are quite enthusiastic today. Okay.
I've seen you typing already to some of the questions. Maybe would you want to pick up on one verbally, or so that people get the chance to hear?
Yeah, there are people who are waving, so maybe we should ask them if they have questions. They have not posted on the chat box. There are a couple on the chat box that we can pick up. Yeah. But let's give opportunity to people to ask the questions.
All right. I can't see the waving here in my screen right now. 1 second. I've just been told that the talking is not possible. So we will have to write the question in the chat box, and then we'll address it. So those waving, please add your questions to the chat box and we'll pick them up from there. In the meantime, I had written a couple down already. So one question was relating to how the business responsibility report content really relates to or gets picked up by GRI and ESG reports. So maybe Aditi and Ramnath can say a few words on this. I think Aditi, you covered it already, but maybe just
I think let Ramnath maybe share his perspective first.
Yeah.
Thanks.
So business responsibility report by SEBI actually addresses some of the key areas. So they've already talked about what are the environmental responsibilities, what are the supply chain looking like, where are the distribution of operations, and what are the compliances that each of the operations areas undertake. So the way we have to look at it is not really the current business responsibility reporting, but the BRSR, which is the business responsibility and sustainability reporting, which is now under discussion. So the way I am looking at it is most of the requirements under environment and social will be mandatorily reported under BRSR. We'll have to wait for SEBI's notification to see if it becomes mandatory, and if it is mandatory, to how many companies it applies. But my initial assessment tells me that 80% of what needs to be disclosed under GRI is in one manner or the other captured under the BRSR. If you really map GRI with the BRR, it is still superficial. We see only 30 to 35% of the points addressed under BRR, but under BRSR, it will go right up to 80%.
Thanks. This is a great foresight and also a very important development to highlight here. that SEBI is taking clear steps to extend the current business responsibility reporting to include environmental and social aspects to a much larger extent. And there was another question that I saw in the chat. And
so Inga,
yes,
hi, Inga. I just wanted to supplement a point here. So whatever be the standard or the reference point of reporting and disclosure, one very important factor here is that how much does a reporting organization use that reference point to disclose information which is relevant to that particular business activity. And that is the major issue here, that most of the time the information that is seen or disclosed in the public domain does not necessarily meet the requirement of the material topics. It is some things that some activities, some ad hoc events or initiatives that the company has taken, and therefore they want to just showcase the achievement. And this is where I think the company who is disclosing the information loses out on the benefit of the reporting, and also the organization or constituency, in this case the investors, who want to really judge the organization to make that capital flow happen, they also lose out. So this is finally, it depends on how much of that framework is being really used. It doesn't really matter, what is the extent to which that standard is, evolved or matured. But I think it depends on the uptake of that standard. That is a key point here. We've been fighting, the credibility of the information that is available. That's a very, very big issue.
And I think here we relating back to transparency and how important it is, like what you're saying, what kind of disclosure or what kind of information is disclosed. I mean, when we do our ESG ratings, we do realize that there is disclosures, but usually on those that positively impact the rating, there's a lot of disclosures, and those that negatively could impact the ratings, the companies are rather hesitant to share that information. And this full transparency really is a matter of trust in the process of getting from one point where they are now and having a clear target and moving towards that and showing that to the investors, and thereby improving the investors' confidence. So I think transparency rating within an ESG rating becomes really relevant to get an idea for the investor also to understand the rating, what is it based on how many disclosures and on what kind of information are the companies being rated, and what are the scores achieved? Are they only those little ones that the company perceived to be beneficial, or is it the comprehensive picture of what is actually happening within a company? Ramnath, Gareth, do you want to add something here? No. Okay, then there was one question where do we get data from for ESG rating? Like what kind of data is usually being used? And reference was made to annual reports and public disclosures, and what is the data points that are being picked up? Maybe Ramnath, you could say something on that.
So currently the disclosures in the public domain are what is largely used for the assessments. So there are two approaches to assessments. The approach one is to send specific questionnaires to companies who don't make elaborate disclosures in the public, and the companies then respond to the questionnaires and the response is used for the assessment. The second approach is where the information disclosed publicly, which is what is available to bulk of the investors, are then structured and used for assessments. Now, what equity or ESG risk AI is doing is a hybrid approach. So what they're doing is they are taking the public information, structuring it, and then providing an opportunity, or at least intent to provide an opportunity to the companies themselves to review the information that has been structured and respond to that. So in case any information is missed or some information is not disclosed in the public domain, the companies have an opportunity to provide that additional information to ESG risk AI, based on which the assessments then will get updated.
Thank you. Panelists, are you looking at the questions also and you feel you want to pick up one particular one? I picked up a couple for now. So until the, but I think we addressed this one also, which is as we wait for the comprehensive corporate reporting framework, a consolidation effort by the standard setters, what would be the position of GRI in the coming years? Is there something to add to what we said earlier, Aditi?
No, I think, we don't have, we are working at it. We have a collaboration and we are, of course, we want to harmonize, different reporting frameworks. But, it is quite difficult to make that happen. So we need to, any organization who's using the framework needs to decide for themselves what is best for them. If they follow a certain framework and if they don't follow a certain framework. But sadly enough, the thing here is the company cannot decide on their own. They just see that what are the peers doing, what are the rating agencies asking, what are investors demanding, and they use that kind of demand to use a certain framework. So I don't have really any comment on the alignment. We are working at it, and maybe someday we have one single reference point of disclosure. Yeah.
Okay. We have a question in the chat box also, two actually. Same person. How can lawyers be involved in ESG related activities? Anybody from the panel has something to add on this? Nobody raising their hand.
Can I just mention here? I think Shankar is the one who I think shared that there are so many regulations in India on environment and so many, like 100 and some regulations on the social side. And this is where I think the lawyers can definitely come in. In fact, GRI has been working with a group of lawyers to see when disclosures are made, how can lawyers become more tuned into understanding the disclosure versus the regulatory requirements. So this is where I think lawyers really need to develop their skills on linking environmental, social, and governance topics and link that to the regulation, because regulation is like one dimension. Either you have it or not, and if you do not have it, then you are sued, right? But on the sustainability reporting disclosure, it is not like that. It actually brings in certain dimension around a topic to link environmental, social, and governance issues together to make the company board or the management to decide for itself. At least that should be the ideal way in which it works. So lawyers need to move from being that single dimension of either breaking or making the law versus looking at a 360 degree of the corporation to come to a conclusion what they should do as a next step.
If I may add it here, is that lawyers are already deeply involved in ESG issues, right? So ESG issues, when there is a failure, it results into controversies. Controversies result into legal issues, and lawyers already play a very important role there. Increasingly what will be critical is for companies to avoid controversies, and therefore the risk and the associated cost to it will need to be looked at from a prevention perspective. So probably the lawyers will have to reinvent their own approach to assisting corporates in prevention of controversies.
Yes, and I found some more questions here that we maybe can highlight, though they have been partially answered already. What percentage of Indian funds are ESG driven currently? And Ramnath, you have mentioned that it's currently estimated to be 7% of the asset under management in India. Any link to what Shankar was saying earlier was that we expect this to increase to 30% within by 2030. So that is one question that was there. And can you please share names of a few companies making disclosures in addition to BRR? Ramnath, do you want to mention some?
Actually, it's quite a long list. What we have found when we were looking at data is that there is no dearth of disclosures. So in case there is a perception that because India is an emerging market, companies don't disclose, the first request is please overcome that. Companies are getting more and more transparent. And the reason is while India is an emerging country, what we have to remember is we are part of the global supply chain. And nobody is going to touch anyone as part of their global supply chain unless there is adequate ESG disclosure. So the perception that India is or the Indian companies are under disclosing is the first thing that we have to overcome. It's, I think, a common misconception, and we have data to prove that it is not entirely true.
Yes, I think this is a great point of also highlighting how companies are active already in it, whether they consciously active or subconsciously disclosing information that relate to ESG rating and data points that we pick up. Maybe as a last question to the panel that we had received also was that are banks using ESG assessments both at sovereign and company level to evaluate their portfolios, performance risk assessment, and to price loans? I know we have some banks in the audience, so maybe this would be something interesting since we haven't covered that yet.
Maybe I can come in on that, Inga. Yes, so at the African Development Bank, we are, well, it's not so much that we're reporting on ESG, but we're the recipient of many questionnaires from the rating agencies about our ESG performance. So we're constantly having to provide information about the procedures and processes that we have in place to ensure our sort of social and governance issues, our environmental performance. And we get a lot of questions about how we monitor and report greenhouse gas emissions. But interestingly, and sort of speaking to my presentation, much less understanding and focus on issues around adaptation. Yes, so our ESG rating is very relevant to our overall credit score. We have a AAA credit rating, and really all of our activities are focused on ensuring that we maintain that AAA status. It's critical to our management of our capital funds. And so, you know, the ESG input to those ratings is considered very important. Thanks.
Thank you. Ramnath, do you want to add a little bit on how banks can use ESG?
So the extent to which I understand is that the financial risk, as I keep saying, from ESG is material. So unless banks are incorporating ESG assessment, they are going to find contingent liabilities that are lurking in the near future. And then the banks may be caught napping simply because addressing these risks will become a priority for companies instead of repaying the line of credit from the banks. So that's one. Second is we will see increasing financial requirements for environment projects. So the moment the government assigned the Paris Accord, let's take it for granted that unless we have huge volumes of renewable energy that is set up, huge efficiencies that industry bring about in terms of the manufacturing process, huge change in the way our transportation systems are run, we are not going to get to zero. And if not getting to zero is not really an option if you want to keep the planet alive. And that is another requirement that we are going to see of the banks. India is not a bond-driven country. It is a bank-driven country. And unless the banks have the practices in place and they know who they're lending to, what is the impact of the lending, and what is the climate change that they're supporting, it is not going to drive active lending decisions. And let's also remember the climate projects are not immediately viable, right? So the yardstick that we have to use is completely different to the normal project finance yardsticks. And unless the banks can clearly evaluate what are the ESG benefits, justifying the lending rates may become difficult because the projects will be lumpy. So I wouldn't be too surprised if a year or so from now, we have clear stipulations, directions, regulations from RBI on how climate change and similar ESG yardsticks have to be incorporated in the lending decision of banks. We have already seen the trend in Europe. We have seen this trend even in ASEAN countries. So India can't be far behind.
Thanks. I think this again makes a nice connection to banks and their involvement in ESG and why it is relevant to them. Looking at the time, we are coming to an end. So first of all, I wanted to use this opportunity to thank our eminent panelists, Dr. Aditi Halda, Mr. Ramnath Iyer, Mr. Garesh Philip, and also Mr. Shankar Chakraborty for sharing the expert views here today. And we will now have to close. But before doing so, I want to use this opportunity to thank you all, the speakers as well as the audience, in providing your expertise, ideas, questions, and participation. I believe in the chat, a few questions are being addressed while I am talking and while others were talking. Those that are not going to be addressed, we will try to address them post the webinar and share circular, a two-pager or something on the main points, the questions and answers. And I really hope that all of you gain valuable insights in today's discussion. The full recording of this webinar will also be available on our YouTube channel, Aquites Mera, for you to share with your colleagues or to review or with the industry network. We also will be sharing that circular that I just mentioned, that then will have all main points in it. And if you wish to know more about ESG Risk AI, you can, of course, always visit our website, ESG Risk AI, or stay tuned and follow us on LinkedIn with regular updates and upcoming webinars and interesting industry insights, or just simply get in touch with us and reach out directly. I really am happy with the discussion today. And I'm really, really thankful that you all took time out of your busy schedules and joined us. I'm really thankful for the very interesting insights from all the panelists. Thank you once more. And with that, we really hope to see you very soon. Stay connected and drive this discourse on ESG together. Make this individual activities a connected mass of a joint effort. And thank you so much for today's inputs and have a great day.
Thank you.
Thank you. Thank you.
Thank you.
Bye.